Okay, so I'm going to do the question. You can see how to approach it. Okay, so question 3. Okay, so in this past paper, question 3. Okay, question 3. M is the sole proprietor and prepares the financial statements for 31st May each year. She depreciates motor vehicles using reducing balance method. That's very important. Reducing balance method. Okay, I need that. 20% per annum. Depreciation is charged monthly. It always is. Depreciation must be provided on the vehicles. Okay. M purchased a motor vehicle on 1st of June. Right. Technique-wise, draw a timeline. What was the start of the year, though? Do they say when the start of the year is? Yes, they do. Prepares the financial statements to 31st May each year. So 31st May is the year end. Okay, that's the end. So if the end is 31st of May, the 1st of June would have been the start, right? Making sense? Okay, the start. Okay, M purchased a vehicle on 1st June 2013. So if this is 2013, she purchased, so buy, how much did she buy? 152,000. Then they say on 1 March 2015, so that's 2013. So we're going to have a few of these. We're going to have start, end, start, end, start, end. This would have been 2014. This would have been 2015. They say on the 1st of March 2015. So 1st of March 2015, that would have fell into this year. 1st of March 2015 would have been somewhere there. Let's highlight that. Okay, this would have been 1 March 2015. A new motor vehicle was purchased. Okay, so new. How much was the new? 190,000. The old was part exchanged at value of 84. Okay, so this took place when? On 1st of March, and then exchange, so disposal of the old proceeds were how much? 84,000. 84,000. Okay, the balance was settled by a bank loan repayable over 3 years. Okay, so obviously if you're buying a motor vehicle and the motor vehicle cost 190 and the proceeds from the trade-in or the exchange was 84, the balance, which is the 190 minus the 84, is that financed with a loan. Okay, have I read everything? Yes, I have. Okay, so now I don't even have to look at the question because I've got the diagram. What did they want here? Prepare the motor vehicles at cost account. Okay, so they want us to produce a T account. So let's draw up a T. See, this is the technique. This is how you would do it. Any question relating to depreciation needs a timeline. If you don't draw a timeline, you're never going to get it right, okay, because it's impossible, okay, you can't picture this mentally, okay, so the correct approach would be to do it this way, just to get the timeline, motor vehicles at cost, that's what they said, yeah, so that's at cost, and then prepare the provision for depreciation, so we're going to need the same T account, but just for a different account. What is this? Motor vehicles provision for depreciation. Okay, so now I've got everything. Now I just need to complete the question. Right. Okay, so now you've got everything on the diagram, just process everything. Okay, so let's see, on my diagram, I'm going to start here because that's the start. Okay, so let me get easy marks for knowing how to record a purchase. I bought the vehicle on the 1st of June, so 1/6/13. Bang, was this a cash purchase? They don't say cash or credit, I'll assume it's cash. Bank, CPJ. How much did you purchase? 152,000. Okay, so that's the motor vehicle. I bought here. Right, then that year is ended, so that's the first year. Nothing happened that year. Here's the second year. Something happened that year. Okay, so what happened in this year? Well, on the 1st of March, you bought a new vehicle for 190. Part of it was financed with the loan, part of it was a trade-in. Okay, so if I'm looking at the motor vehicle, I need to record the vehicle that I've purchased. So, 1/3/15. Okay, part of it was a loan, so they say finance, yeah, settled with a bank loan, so bank loan, general journal, and that would have been for the 106,123. Okay, then the parts would have been the proceeds from the sale, so you would have exchanged it, so then you would have had the separate one here, which would have been copy paste that.
So the basics for loan, credit loan, so debited in motor vehicles.
Yes. Okay, because motor vehicle goes up when you buy a motor vehicle. Alright.
It's better to see the word loan in the motor vehicle.
Well, it's possible if you finance it. So, and then this one would be proceeds, so it would be in cash, because you exchange it for cash, right? What did they say? The motor vehicle was part exchange at value of 84. So 84 would have come in bank. Okay, how much was it? 84,000. Right, so if you add up those two amounts, that makes up the 190 there, which was on the 1st of March. Okay, did anything else happen on the 1st of March? Yes, I sold the old motor vehicle. Okay, so the old motor vehicle was this one here, right? So I'm selling it, it would have gone to an asset disposal account. And that would have taken place on the 1st of the 3rd, 2015, disposal. Okay, realization account, that's what they use. Okay, general journal, 152. Right, did anything else happen to my motor vehicles during those 3 years? No. Balance off this account, and that's it. Okay, so if I sum up the left and the right, the left gives me a total of 342. That's obviously bigger. So then balance brought down, balance carried down. The balance will be the difference. This minus that. 190.
Cool. So then the provision for depreciation, that is a negative asset, am I right? So
it's accumulated depreciation.
So it increases, yeah.
Okay, so look how easy that was if I just do a timeline.
Yeah.
That's the approach. That's the exam technique.
Okay, so then it said the provision for depreciation.
Okay, so now let's do
for
that.
2014 and 2015. So we have to split 2014 and then 2015.
Yeah, well that's fine. I'm not going to look at the answer because I'm practicing. Okay, so don't look at the answer unless you've attempted it. Okay, this is my attempt. Okay, then I look at the answer and then I see, well, was this right or wrong? If it's wrong, then I review. Okay, where did I make a mistake? Go back and look at it. Yeah, so the question, yeah, said 2014, 2015. So that's good. I'm going to look at everything for the year. So this was 2014 and that was 2015. Right, so what am I going to do? I'm going to process depreciation. Did I have any depreciation at the beginning of the year? No. So the balance would have been 0. Nothing to start with because that's the start of the financial year. Okay, how much did I have here? 152,000. Did I use that asset for the full year?
Yeah.
Yes. So must I have depreciation for the full year? Yes. Okay, so depreciation is going to go here for the year ended 31st of the 5th, 2014. Right, and that depreciation is going to be this times, what is the rate? I wrote it down, 20%, 0.20. Okay, so there's depreciation. Right, so now I go back to my diagram and I can write this down now.
So
cost
per annum is per year.
Yes. Cost accumulated depreciation. Okay, I know that the cost is still 152. Cost is cost. You can't go back in time and change the cost. Do you agree? But I can change the carrying value. CV. Accumulated depreciation at the end of this year is how much? Well, that. Carrying value is going to be this minus that. Okay, so there's my carrying value. So now I've got the figure for the next year. Okay, so now I've got to ask myself, if I look at my diagram, have I used this asset for the full year? No, I've only used it up until there. Okay, so this old asset was sold on the 1st of March. So from the 1st of June 2014 to the 1st of March 2015, the asset has been used. How many months is that? June, July, August, September, October, November, December, January, February. 9 months. Okay, I count June because it's the 1st. I don't count March because it's the 1st. Okay, so now I need to process that depreciation. So that's easy. Let's put it in. 1st/3rd/15 depreciation. Okay, the depreciation on that would have been open brackets. The carrying value, which I can show 152,000 minus 304,000 close brackets times 20% times 9/12. Okay, so equals this times 0.2 times 9/12 gives me that. Okay, so now I know that's the depreciation. Let's highlight these things. There's the depreciation for that. There's the depreciation for that. Okay, what else do I need to know? Well, I also sold an asset. So if I sold an asset, I need to take out depreciation from the asset that was sold because that's the disposal. So I'm going to have the disposal here, and this would have been for the depreciation on the asset that was sold. So what's the total depreciation on the asset sold? Well, it's the 34,000 plus the 18,000. Okay, that 48,640 is for this old asset that's now going to be sold here. Okay, that's it. Now I just need this little part over here. Okay, so I bought a new vehicle, didn't I? Yes, there's it. Did I use that vehicle for the full year? No, I didn't. So must I depreciate it? Yes, I do. March, April, May, 3 months. 3 months for that bit over there. This I could have put a closing balance here and an opening balance here. I'm going to just fix this just to make it better. Let's move that down. Because this is going to be, copy this. Okay, that's the 8. Where's the 8? Okay, I'm going to work it out. Copy this. This times 20% times 9/12. Yeah, I just want to add a balance brought down, balance carried down for this bit, just because they're 2 different years. That's all. Okay, so if you really want it to be year by year, then you had to have put this in. So for this year, you only would have had a balance brought down, balance carried down, balance, eh? Okay, balance brought down, balance carried down. Okay, then I would have shown this total. Okay, that would have been more accurate, just to show the year on year. Okay, so this was the end of the first year. Okay, so you had a balance of nothing, you had depreciation of that. Okay, then you had a balance of that brought down. So this is the balance for the new year. Okay, that's the depreciation, that's fine. And then the disposal would have been this plus that. Okay, what else there? New depreciation. Okay, so for this year, I've got more depreciation. That would have been for 31st May 2015, and that would have been depreciation, and that would have been for the new asset, which was 190,000 times 20% times 3/12. Okay, so this times 20%, 0.2 times 3/12 gives me 9,500. Okay, and then I can just balance this off because that was X. Right, so I've got opening balance, closing balance. This side is bigger, sum up. This side, come on, sum. This side gives you that, balance brought down would have been this minus that, that would have been balance brought down, carry down, balance brought down, balance carry down. And that's it.
So here they used, on this side you used depreciation and they used income statement. Which one's more accurate?
Income statement, the textbook will answer that for us.
Well, I never had income statement. What does it mean when they say income statement?
Income statement, because depreciation is what? What is depreciation?
Expense.
Where do you put? Yes, exactly. But let's see the textbook.
That means that's what kind of then that's what they want to say.
But the memos aren't always correct, so you need to follow the correct theory. So you should write depreciation. Depreciation of non-current assets, page 145. I think you do write depreciation. Let's just double check with the textbook. Let's see. Okay, depreciation of non-current assets. How do they want you to record? Okay, they do want you to do it that way. They want you to write an income statement, so that's fine. The memo is now in the textbook. Yeah, but what does that represent? It represents the depreciation. Okay, so I want to write income statement brackets depreciation, so you know what it is. But yeah, firstly, it shouldn't make a difference. But if they want to be picky, they'll mark it wrong.
I'll just do it that way.
Yeah.
In case. Okay, then the rest is what comes. A lot of theory actually.